As volatility remains elevated and equities in particular see erratic daily swings as liquidity is drained from the financial system, investors seem desperate for direction in the midst of the current bear market. Given the Fed's relentless focus on fighting inflation, might the signal come from the labour market? That's the big conversation. Last week provided the latest update on inflation, with many investors bracing for bad news. Ahead of the report, a survey of hedge fund positioning reported by Goldman's prime brokerage unit revealed that clients had been net sellers of equities for the past 5 straight days, with the largest net selling occurring the day before the CPI print. And what's more, as opposed to this representing the liquidation of long positions, hedge funds were selling stocks short at a ratio of 5-1 as the S&P 500 tested new lows. In other words, traders were already positioned for CPI coming in a lot hotter than expected. At first take, the headline CPI print perhaps didn't seem so bad. In fact, it slowed for the 3rd straight month and reached the lowest level seen in 7 months. But much of this seemed to be driven by a lesser than expected increase in fuel prices, which didn't capture the sharp rally in oil that we've seen in October so far. And furthermore, it was the stickier things like the cost of shelter and healthcare that saw faster than anticipated growth and have been persistent contributors to inflation. And this showed up in the arguably more pertinent core CPI number, which came in ahead of expectations and rose to a 40-year high, and had some on Wall Street preparing for a jumbo rate hike at November's FOMC meeting. Whilst this provided a stark contrast to the slowing momentum in the headline data, albeit driven by a decline in fuel prices, which have since reversed, it seems that the volatility in the wake of the report was a result of extreme speculative positioning rather than a fundamental shift in the inflation theme. And this becomes clearer when viewing the market from a technician's perspective. Looking at the S&P 500, we can see that the low of the day came as price tested 3,500 before staging that intraday reversal. Not only is 3,500 a widely watched level and round number, but it also coincides with a 50% retracement of the rally from the March 2020 low to the high seen of January of this year. In other words, technical factors were also behind the bounce despite the inflation data. But is this a sign that we could be nearing a bottom as equities stop going down on seemingly bad news? As the saying goes, there's nothing quite like price to change sentiment, and bear market rallies do tend to catch investors off guard. But if history is anything to go by, then this may prove to be premature, and there might well be a new low yet to come. To explain this, we need to understand that CPI tends to peak during or after a recession. In other words, it seems unlikely that inflation will subside without a full-blown recession. And it doesn't seem like we're there just yet, as recessions also tend to coincide with a surge in unemployment. And right now, whilst business activity is undoubtedly slowing, the unemployment rate remains at just 3.5%, which is as low as we've seen in the current cycle post-pandemic. Now, you could argue that unemployment is a lagging data set, but initial jobless claims have yet to show a meaningful increase either. Despite the Fed implementing the fastest series of rate hikes in decades, the number of claims remains subdued and well below the levels that have historically occurred during recessions. Could it be that perhaps this time is different and we don't see any deterioration in the jobs market despite a recession? Or perhaps that the Fed pulls off the economic miracle of a soft landing, bringing inflation under control without triggering a recession at all? It seems unlikely, but that's what the fast money seem to be betting on in calling a peak in inflation. But this may once again prove to be premature, just as it did in June when we saw the market rally on the false hope of a pivot. Whilst equities saw a technical rally following that inflation print, fixed income traders moved to price in even more aggressive rate hikes, as can be seen in the implied Fed funds rate. The 5-year break-even rate, which gauges market-derived inflation expectations, also ticked up and added to the 20 basis point gain that has been largely driven by the rally in crude oil that we mentioned earlier and also explored in last week's episode. With core CPI rising to its highest level since 1982 and the energy crisis far from resolved, any further strength in crude will spell bad news for inflation optimists. And if history is any guide, then the Fed funds rate may need to match or exceed the level of core inflation in order to truly vanquish it. And given that core CPI currently stands at 6.6%, it suggests that the terminal rate may end up a lot higher than current expectations. However you cut it, it seems that inflation will likely remain a threat to investors and consumers alike, and there's little doubt that this will perpetuate the demand for higher wages amongst workers. And this is certainly on the Fed's radar, given the stickiness that wage inflation brings. And this is why the labour market is key to the inflation conundrum and the direction of monetary policy going forward. If the recent pay agreement for US rail workers is anything to go by, which included an immediate 14% hike and a 24% increase by 2024, then employers could see their cost base increase dramatically. Though in reality, it seems that beyond the critical point, companies will look to make cutbacks in order to defend their margins, which inevitably spells layoffs. And this might well be the catalyst for a national rise in unemployment and would get us closer to that earlier scenario where a recession brings a peak in inflation and most likely interest rates with that too. Investors will no doubt be paying close attention to company guidance during earnings season in an attempt to glean insights around cost reduction initiatives. And others may follow Intel, who last week announced plans to cut up to 20% of their workforce, citing a demand slowdown. So whilst the rally in oil may have further to run and could put further upwards pressure on inflation, this really is a story of wage expectations and the labour market for investors trying to time a Fed pivot. To better understand these dynamics, I chatted to Indrani Day, Head of Global Investment Research at the London Stock Exchange Group, about some of the key trends and structural changes taking place beneath the surface of the labour market and how these might influence the outlook for inflation, rate hikes and risk assets. So Indrani, lovely to meet you, and what a time to be talking about labour markets and I guess anything related to equities and asset prices in general. It's been a heck of a year 2022 so far, and it seems that all eyes at the moment when it comes to trying to figure out what the Fed's going to do next, whether they slow the pace of rate hikes, perhaps pause, or maybe even if we see a pivot at some point, all eyes are ultimately now on the labour market in the US. So in terms of the inflation and unemployment picture, how do you see things at the moment?
So thank you, James, firstly for having me on the show. Delighted to meet you. So glad to be here. Now, it's absolutely true. This has been such a fascinating year to be in the investment world. And all eyes really are on inflation and what the Fed's going to do. So I think a couple of things, it's important to step back and say, when we talk about inflation and the Fed pivot, what measure of inflation is the Fed really using? The markets talk a lot about the CPI numbers, but because of methodology reasons, the Fed really concentrates on the core PCE number. Now, their target for that is 2 percentage points, and pre-COVID, because we went through an era of low inflation, they changed their target to not just 2%, but on average 2%, meaning after years of low inflation, they are ready to tolerate a little higher than that 2% core PCE. And that number is currently running at very high fours or just about 5 percentage point. It's important to lay out, so where are they targeting, where are they now, and how much more to go. So that's one thing. Again, it's important to do a little more deep dive into the drivers of inflation and where things are. Supply chain disruptions, so much better than beginning of the year, getting close-ish to normal. Then commodity prices, they have come down a lot. Expectations in the financial market and consumer fairly well anchored and coming down towards the Fed level, particularly in the short term, medium term kind of thing. For the US economy, very important to remember that the very strong dollar reduces import inflation. Finally, China is always a big, it really has an impact in markets, and we are now seeing disinflation, low inflation coming out from China. Corporate pricing power is reducing. These are the good things. On the bad side is the fact that inflation has spread from being a good story to a service story, and the US economy is ultimately a service economy. So that's not a good thing, and the fact that it's so much more widespread, that's not a good thing. So where are we? The difference between where we are now, core PCE around 5, needs to come down to about 3 percentage points, and we talked about the pluses on the inflation picture side. minuses on the inflation picture side. The labor thing is actually a very, very interesting point because increasingly the Fed's looking at the labor market for, uh, uh, its decision making. So three things I want to point out there. In some sense, unemployment is a lagging indicator because corporations having gone through very tight labor markets, things have to really deteriorate in their margins and earnings before they start laying off. That's one thing. Second is the headline U3 unemployment number or a broader U6 number. They are all still very tight at pre-COVID levels. But it's very important to point out the structural changes that have happened in the labor market. I mean, even before COVID, your natural born population growth rate was pretty much flat. The growth was coming in through immigration. That obviously pre-COVID was also going away. Now even more so. But the biggest change is a structural change of labor force participation rates have gone down. And I would argue, there are points in time that are big shock right after the Second World War or changes in societal, norms in the 1960s and now COVID. These are big points when there is a structural change in labor force. And I would argue we are in one of those periods because of which labor force participation will probably remain lower than what it has been. So that's something to consider as we talk about the inflation and what the Fed might do.
Interesting. There's certainly a lot to unpack there. And I suppose the big question, without being too blunt or disrespectful of the policymakers at the Fed, is a question of, do you think they have a real understanding and an awareness of all these multi-layer or faceted aspects of what you've just discussed there when it comes to unemployment? Or do you think they are a little bit more blunt or objective when it comes to focusing on, say, core PCE for inflation and perhaps focusing at unemployment and some of the lagging data that you mentioned, as opposed to, I'm sure that they are aware of the participation rate, but some of the nuances beneath the surface. To what extent do you think that's ultimately influencing the policy decisions going forward?
I think the nuances that make things very hard for any decision maker right now is because the inflation numbers were so much higher and they needed to bring inflation under control before expectations make it entrenched. So what I mean is they were very correct in saying inflation is their number one, priority to get it under control. But that has two implications. One is because they are doing so much tightening in financial conditions, but monetary policy works with a 12 to 18-month lag. So right now, all policymakers are kind of, they haven't seen the full impact of all they have done, but they are still doing more because the picture still indicates there is more to be done. So how much will be the final impact? That is an uncertainty. Second, because inflation right now is fairly global, at least in North America and Eurozone, in many emerging markets, things are actually much better. But each central bank has control on things within its national boundaries, which means each central bank is doing by seeing the picture within their national boundaries, but it's a very tightly interlinked global economy. So what happens in one central bank and their actions has enormous feedback loops and connectivity to other countries, and that's very hard for any one central bank to take into account. As I like to say, at this point it's not 1 plus 1 equal to 2, it's 1 here and 1 there and 1 there, leading up to a much more cumulative effect across the globe. I think those are the two big uncertainties and where the Fed and other central bank policy tightening will end up having how much impact on the real economy and financial markets. And as we can talk more about what we are seeing because of all this in various parts of the financial markets.
Sure, and I mean, it couldn't be more close to home, as the saying goes, than being here in the UK in terms of or in light of the recent moves and intervention by the Bank of England and subsequently it stepping back. To what extent do you think other events or other central bank policy decisions or pivots could influence the Fed's path from here?
It's factors. One is the role of the US dollar as the reserve currency. And anytime there's uncertainty in the world, money flows into the US dollar. So the US dollar being super strong, 20-year high, and very strong against all the leading currencies, whether it's euro or the British pound or the Japanese yen. And that is something definitely to keep an eye on, because extreme currency movements can create a lot of problem. Because it has impacts on the real economy, who can export how much, import price inflation. Then so much leverage has built into the system over the last 10, 15, 20 odd years when we had low rates. So rising rates and now a strong dollar, because a lot of those leverage is in dollar terms. Those are certainly risk factors we need to keep in mind. And those are the reasons why the central banks need to work in very close, cohesive manner. Because as we saw with the UK markets, what happened in the UK markets immediately created so much turmoil in all financial markets, including US.
We're, of course, going into earnings season now effectively in the US. And in terms of the labour picture and hiring decisions, or perhaps cues where cost reduction plans might be enacted, are those the types of things that you're going to be focused on, and you think investors should be focused on going into this season?
Absolutely, absolutely. I mean, equities are driven by earnings growth, valuation, and the volatility is what defines the path between now and the ultimate investment horizon. So that's why it's so important. See, earnings growth expectations, they have definitely come down, but probably they could come down even further, because as we talked about, the full impact of the monetary policy tightening is yet to show up, which means there is more downside risk in earnings growth. And earnings growth is both a function of the revenue growth, which is most directly related to the economic growth, and the margins expansion. So earnings expectations are coming down, and probably there are reasons to have more downside to it. Valuations, the equity valuations are very closely related to real yields, not nominal, real. Now, real yields are going up, and valuations from that perspective, if real yields go up a little further, as the trend right now is, then valuations itself can come down a little bit more. And volatility, given everything that's going on, volatility will probably remain high. So one way of looking at it is, where are valuations now? Yes, certainly they have really come down. I mean, they are lower than the 5-year, 10-year averages. They are close to the 20-year average. And we have to remember in the last cycle, a whole lot of the equity market returns came from expanding valuations. Today, we are in a world of contracting valuations, but valuations is PE, and the earnings part of it also has further downsides. So all these intermixing, of the variable, it's super important to think through. Yeah. But to answer the question very succinctly, yes, given real rates, there could be a pressure on valuations. Given everything that has yet to show through from the tightening financial conditions, the earnings growth have more pressure. And again, the currency part is important for a US investor. While strong dollar is good for the inflation front, it is not so good for the earnings growth, because so much, roughly around 40% of the earnings growth of the Russell 1000 index comes from outside the US. So a strong dollar hurts that earnings growth expectations.
What a great way to wrap things up, Indrani. And I think that whilst it's very much a macro environment, heading into earnings season, and in light of everything that we've said, and ultimately Labour being central to the Fed's decision making, and as perhaps having a hope of taming inflation, it's now also an environment where we need to be super focused on what companies are saying in terms of what they're reporting, but also their expectations and plans for perhaps cost reduction and job cuts, if we are indeed to see an uptick in initial jobless claims and eventually those lagging data as well of unemployment. So thank you very much for your time, Indrani, and we'll see how this plays out.
Thank you so much.